Looking for steady passive income? In today's video, I'm revealing 5 of the best dividend-paying ETFs for this year, some of which even pay out every single month. And the best part? You'll see exactly how to build a monthly dividend portfolio using ETFs so you can start collecting income all year round. Let's find out now. First up, we've got a classic pick, the VanEck Morningstar Developed Markets Dividend Leaders UCITS ETF. This ETF tracks the Morningstar Developed Markets Large Cap Dividend Leaders Screen Select Index, made up of 100 large cap companies from developed markets with a strong, sustainable history of paying dividends. It also applies an additional ESG filter for responsible investing. It uses full physical replication, so you're actually investing in the underlying companies, and it pays dividends quarterly. The dividend yield is around 4% per year with a total expense ratio of just 0.38%. In terms of total return, it's outperformed the S&P 500, delivering around 140% over the last 5 years and 40% over the past 3 years. That's down to a powerful combo of consistent income and share price growth. It's a solid choice if you're after steady income from global equities backed by established companies with reliable cash flows, while still offering some potential for long-term growth. Second on the list is the iShares UK Dividend UCITS ETF. This ETF tracks the FTSE UK Dividend Plus Index, which includes 50 of the highest yielding companies from the FTSE 350, excluding investment trusts. It focuses on large, well-established UK firms with solid dividend histories across sectors like consumer goods, finance, and energy. Dividends are paid quarterly, giving you 4 payouts a year, and the current yield sits around 6% annually. With a total expense ratio of just 0.4%, it's competitively priced, and its long-term performance has made it a popular choice among UK income investors. If you're looking for reliable income from UK companies, this one deserves a spot on your watch list. Third on the list is Global X S&P 500 Covered Core UCITS ETF D. Now let's dive into a more dynamic option. The Global X S&P 500 Covered Core UCITS ETF D mirrors the S&P 500 index and employs a covered call strategy to enhance income. Each month, the fund writes covered call options on the S&P 500 index, simultaneously purchasing higher strike calls. This approach allows it to collect premiums upfront, facilitating monthly dividend distributions while retaining some upside potential if the market rises. Currently, the fund offers an annual dividend yield of approximately 9.09% with a total expense ratio of 0.45%, making it one of the more cost-effective options among UCITS ETFs employing similar strategies. However, it's important to note that while this ETF performs well in bullish markets, it may experience significant declines during periods of extreme volatility. For instance, in April 2025, the market fell by 25% due to concerns over tariff policies. As depicted in its performance chart, the fund lost the gains accumulated in the preceding months during that period. Nevertheless, it has maintained a 12% return over the past 18 months. The fourth ETF is iShares USD TIP 0-5 UCITS ETF. Next up, we have the iShares USD TIP 0-5 UCITS ETF, a fund that invests in US Treasury inflation-protected securities, with short-term maturities ranging from 0 to 5 years. The fund works by selecting a representative sample of these bonds, rather than buying them all to improve efficiency. Every 6 months, the fund distributes the interest, or coupons, generated by these bonds to investors via dividends. Now, while the ETF's long-term returns might not be the most exciting, that's not the primary goal. Remember, this is a fixed income product. Its main objective is to preserve purchasing power adjusted for inflation, rather than aiming for significant capital growth. So, this ETF can be a great way to diversify your portfolio away from equities and provide a buffer against major market downturns, giving you peace of mind when the stock market gets volatile. Overall, it offers a dividend yield of 6.78% with an incredibly low TER of just 0.1%. And the fifth ETF is JP Morgan Global Equity Premium Income Active UCITS ETF. Now, let's wrap up with an ETF that, despite being relatively new, has been performing pretty well. This actively managed fund from JP Morgan invests in equities from developed markets worldwide, focusing on undervalued companies. It also uses an options strategy on indices to generate additional premiums, which are distributed to investors every month. And to be honest, it's had a solid performance in its short life. Over the past years, it has delivered a return of 13%, slightly outperforming the S&P 500 and with the added bonus of monthly dividend payouts. Currently, it offers a dividend yield of around 5.75% annually, and its expense ratio is impressively low for an actively managed product at just 0.35%. Right, we've covered the most interesting ETFs for this year, but now for the big question. How do you create an ETF portfolio that allows you to receive dividends every month? After all, we all want to see our passive income grow on a regular basis, don't we? Of course, many of the ETFs we've looked at offer quarterly payouts, but let's dive into how you can achieve monthly dividend income. It's much simpler than it seems. All you need to do is check the details of each ETF on platforms like Just ETF to see when they distribute dividends. Then you just combine them. For example, if the Vanguard FTSE All-World High Dividend Yield UCITS ETF distributes dividends in March, June, September and December, and the SPDR S&P Global Dividend Aristocrats UCITS ETF does so in February, May, August and November, the strategy becomes simple. You just add both ETFs to your portfolio, ensuring you receive dividend payments every month. Additionally, you might notice that the Global X S&P 500 Covered Call UCITS ETF, which focuses on a covered call strategy, along with the Vanguard Corporate Bond UCITS ETF, which focuses on fixed income products, both offer monthly dividend distributions. This way, you can balance out the ETFs that pay quarterly dividends. Indeed, the long-term returns of these monthly dividend ETFs are slightly lower than those of quarterly dividend ETFs. However, in return, they offer the benefit of monthly income. Moreover, you're not just spreading your income throughout the year, you're also diversifying your risk by combining fixed income and mixed income ETFs with those that focus on mature equities with predictable dividend payouts, as well as those that use options strategies. And by the way, if you enjoyed this video, we recently published one about how to create a portfolio of stocks and bonds that can secure your retirement in the future, which you can watch here. And with that will be all for today. I hope you found this content helpful. Make sure to hit the like button, subscribe to our channel for more content like this, and I will see you in the next video.